Welcome to Capital Link's company presentation series.
Hello to everyone. I am Aristidis Sbarounis, President of Capital Link, and I would like to welcome you back to the 2024 Capital Link's corporate presentation series. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are pleased to have with us today the senior management of Okeanis Eco Tankers, specifically Mr. Aristidis Alafouzos, CEO, and Mr. Iraklis Sbarounis, CFO. Okeanis Eco Tankers is a leading international tanker company providing seaborne transportation of crude oil and refined products. Okeanis is listed on Oslo Børs under the symbol OET and the New York Stock Exchange under the symbol ECO, ECO. Now, in terms of logistics, we begin with a company presentation followed by Q&A. Please note that participants can submit their questions through a Q&A button at the bottom of the screen during the webinar at any time, and your questions will be answered during the Q&A session. Before we begin the webinar, kindly note the disclaimer that this discussion is strictly for informational and educational purposes and should not be relied upon, and the webinar does not constitute an offer to buy or sell securities. It is not investment advice or advice of any kind, and obviously Capital Link bears no responsibility for the content. Now, let us begin our discussion. I'd like to pass the floor to Aristidis and to Iraklis. Please go ahead.
Thanks, Nico. It's great to have the opportunity to participate in this. Obviously, we'll be discussing matters of forward-looking nature, and standard forward-looking disclaimers apply. Aristidis will kick us off.
Thanks, Iraklis. Well, we think that OET is the best platform for crude tanker exposure. And I want to point out 5 of the pitches or promises that we made during our first roadshow in 2018 and how we've fulfilled them until now. The first being, we know the market and the cyclicality of the business. When we were on our first roadshow in 2018, trying to raise equity for OET, and new building VLCCs that we had ordered were 85 million, and we found that to be an opportune time. Since then, new building values today, basis the last done, is around 128 to 130 million, so they're up over 50%. The Alafouzos family was and is and will remain fully aligned with every shareholder. That's something we promised and something that we believe that we've delivered as well and will continue to deliver. And another element is that one other promise that we wanted to provide investors with, let's say, the best attributes of a private Greek shipping company in a public sphere. And these private attributes are just operational and commercial excellence. We really think that we've performed here as well, and benchmarking against our listed peers also doing these webinars, we've outperformed them by 21% on the VLCCs and 41% on the Suezmaxes. We believe that this is partly due to our superior and more efficient fleet, but also due to our commercial decision-making and the relationships we have in the market. Our vision in OET was always that the profits, or most of the profits, almost all of the profits, would be returned to shareholders, and principally in the form of dividends. We were ready to return 1.1 times our initial market cap in distributions, and an investor who invested in our IPO, taking into account share appreciation, dividends, share buybacks, return of capital, and reinvestment of the distributions, would have had a return of over 420% today. And the fifth and final point, it wasn't easy to convince investors in 2018 to support a Greek management team. So we created a very transparent structure and asked 3 of our US-based investors to sit on the board, who are hedge fund managers, and they're still on the board today. So we're quite happy with the pitches, promises we made, and how we've delivered on each of the 5. And moving on to slide 4. Again, we just cover some elements about the company. We're the youngest tanker company in the market and have 100% scrubber fitted eco fleet. We consistently outperform our peers, and our LTV today sits just below 50%. Given our commercial outperformance and the benefits from our fleet being more efficient and the market timing of our entry, we are generally comfortable with higher leverage in order to optimize shareholder returns. But as asset values have appreciated greatly since we bought the asset, we're very comfortable with the current leverage we have now. And in the final box on the bottom right, our focus again is returning value to shareholders and outperforming our peers. So now I'll hand you over to Iraklis for the fun part.
Thanks. Let me first take the opportunity to go over our recent changes to the capital structure. This slide does not yet reflect the announcements we made quite late last night, but let me just give you a brief overview. Back in 2023, we did a couple of refinancings. One in the summer when we did one VLCC and two Suezmaxes with ABN at 190 basis points over SOFR and pushing maturities to 2028. Then a second transaction in October with Crédit Agricole, refinancing two Suezmaxes at 185 basis points over SOFR and pushing maturities to 2029. So just last night, we announced three essentially transactions that we just signed. A couple kind of go together. So we have expanded the successful relationship with CMB Leasing, adding another sale and leaseback with them, the NYSE Sanafi, at 190 basis points over SOFR and maturity in 2031. That's an improvement in pricing from current terms of approximately 50 basis points. Along with this, we negotiated with the CMBL improved terms on the existing facilities, improving pricing by approximately 60 bps on each of the vessels. We also agreed with them to drop some heavy penalties in case of early refinancings, adding flexibility for the future. And we also extended maturities by 7 quarters each to the end of 2030 for the NYSE Okeanis and March of 2031 for the NYSE Mikulia. These transactions are indicative of our relationships, the relationship we have established with the financiers and our ability to improve on aggregate terms when we identify the right opportunity. Furthermore, this year we're finally approaching the milestone, the key milestone in our capital structure, with the opportunity to refinance our two legacy leased Suezmaxes. That's the Milos on the top left corner in the Poliegos. And we're pleased to confirm our plan now for the Milos, also announced last night, which is expected to close next week. We have utilized the momentum of our 2023 transactions, achieving pricing at 175 basis points over SOFR and maturity in 2030. The interest expense alone is improved by approximately $4,000 per day for that vessel. We're quite pleased with the continuous steps over the last 9 months of improving our structure and want to continue using this momentum as leverage on the discussions that we're having on the Poliegos, which will be due for refinancing in June of this year. And this will be the second in the series of 4 milestone transactions with the opportunity to significantly improve our interest costs. Moving on to slide 6, it's not only the nominal outperformance we have achieved in our stock, but our core of returning value to our shareholders is well evidenced by the latest calculations of total shareholder return. This has already alluded to those. So an IPO investor from 2018, assuming conservatively reinvesting all distributions, has received a return of over $44 per share, or over 400%. Slide 7, we continue to be true to that principle of returning as much as possible to our shareholders. Over the last 12 months, we have essentially distributed our entire cash flow. Since having a fully delivered fleet, we have averaged a 90% payout against our EPS per quarter, typically varying between 80 and 100%. Just in terms, on slide 8, in terms of the last reported quarter, the third quarter of 2023, we had achieved a fleet-wide time charter equivalent rate of approximately $49,000 per vessel per day, and that included our 2 Suezmaxes trading on legacy time charters. Adjusted EBITDA of $45 million, adjusted EPS of 63 cents per share. Cash balance stood at approximately $82 million, and in relation to that quarter, we distributed in November 60 cents per share, which is 100% of reported EPS. So we are on track to report record commercial and financial results for 2023. A couple of weeks ago, we issued a commercial update. So as of the date of that release, which was January 22nd, we estimate the following in terms of our TCE revenue. For the fourth quarter of 2023, our VLCC spot results stood at approximately $45,000. Our spot Suezmax result was approximately $52,000. And overall for the fleet, including the 2 Suezmaxes on time charters, we estimate approximately $45,000 per vessel per day for the quarter, not too far from our Q4 guidance from back in November. In December, we took delivery back of the Nissos Sikinos and the Nissos Sifnos. So with 100% spot exposure, as of the date of the update, we estimate for the first quarter, 61% of available spot VLCC days at $76,000 per day, and 41% of available spot Suezmax days at approximately $59,000 per day. We'll be in a position to update the market further at the end of the month when we report the Q4 earnings. Next slide, number 10. If you followed our presentations in the past, you may have seen this before. The operating scenarios are obviously indicative, but while our market cap has significantly increased since then, given our fleet composition, spot exposure, superior commercial performance, and improving capital structure adjustments, the potential for cash flow generation is astounding. I'm going to turn the slides over back to Aristidis for some market updates.
Thank you. Look, I think generally tankers have a lot of interesting tailwinds pushing us into this bull cycle. Like some are shorter term and like may impact more immediately, so others are medium term. This slide highlights the fact that, you know, all oil or most oil production growth is happening west of the Suez, while demand growth is happening east of the Suez, and it creates, you know, the need for longer voyages to cover these this growth in demand. This has been happening for a while now, as we've seen the U.S., you know, increase a lot their exports, as well as Guyana and Brazil, especially after the war in Ukraine started, which also dislocated the fleet and created inefficiencies in trading, where Russia was efficiently trading into Europe most of Europe's crude needs. All of a sudden, this all got displaced on voyages where 3 or 4 times the length into China or into India. And not only this, but also Europe needed to import oil from farther away than Russia as well. So this dislocation in where growth is happening and where production growth is happening, where demand growth is happening versus production growth, is very bullish on ton miles, and it's, you know, impacting the Russian as well. And on the next slide, we look at a more immediate, let's say, tailwind that could have an impact to the market, and something we're already seeing. The issues by the Houthis in Yemen, initially it impacted, you know, the container, the LNG, like where you saw diversions of large percentages of fleet, and clean and crude were, you know, I think they were the last to be impacted and start really diverting on a larger scale. Today, most Western owners do divert. There still are some Greeks that go through, and there is a large proportion of the Russian business, whether laden coming southbound or ballast returning to load on the shadow fleet, still going through. But this will create an immediate impact into the market, as now Suezmaxes are rerouting around the Cape in most cases, in all, you know, in the majority of cases. And this applies both to let's say, Libyan or Azeri or Kazaki or Northwest Europe crude or fuel oils that are being sold from the west to the east. So, you know, it's quite efficient to load in Libya. It's 2-3 days to the Suez and then on to Singapore. Now, if you have to go all the way around the Cape of Good Hope, it really lengthens that voyage. The same applies if you're loading in Ceyhan in Turkey for Azeri crudes, or in the Black Sea for Kazaki crudes, or in Rotterdam, or in Norway. The same applies for crudes that come west to be fed into Europe, which is principally the Basra heavy. You know, it's a 15-20 day voyage into Greece or Italy or Turkey, and then it becomes a 40-day voyage, 45-day voyage if it has to go around the Cape. We had 3 of our ships which were laden. Sorry, excuse me. Sorry. We had 3 ships which were laden as this was the tensions were intensifying, and we actually got them diverted around the Cape as well. And I think that this occurred when most of the major Western owners took the decision to go around the Cape. I think that the impact of the Red Sea on the crude market will take longer than, let's say, the clean to see the real tightening in the market. I think we have to see the fleets rebalance before we see proper tightening, which I expect to come. We've seen some indications that it will come, but I think there's more to come as well. I mean, there's some interesting things happening. Like we're seeing that instead of Suezmaxes loading in the AG to come west as they were through the Suez, it's more efficient to take VLCCs west around the Cape of Good Hope, so they end up loading 2 cargoes. But overall, dislocation in shipping is bullish, and I think the effects for crude we'll see them in the next 2-3 weeks in terms of the freight market. Another short-term tailwind that's the current U.S. sanctioning policy on the shadow fleet. So since the fall of last year, we've seen 25 Aframaxes about being sanctioned by OFAC. And what the interesting thing that we've seen is that once these vessels have been placed on the SDN list, they can no longer continue trading. So some are even sitting laden, some are sitting ballast, but they're all sitting. None of them are continuing their voyages. So we look at them as like temporary removal from the active fleet. This is interesting because if the US continues this policy of putting the shadow fleet on the SDN list, it's going to force the Russian trade to do, you know, I think 2 things. Either it'll force the gray fleet to replenish itself, which will boost asset values on one hand, and also draw ships from the Western fleet into the gray fleet. So it tightens the Western fleet as well, or the normal fleet. Or it'll force the Russian-related cargoes and traders to comply with the price cap regime to replenish the loss of the sanctioned ships, which is, again, pulls Western ships into that trade and tightens the overall market. So, you know, these are 2 short-term things that will be very impactful on the market, on freight. Now, looking at a little bit more medium and long-term headwinds. In my career, which I started working in 2009, so it's mostly been poor, and I think like we've been a bit conditioned to that with Iraklis. Also, his history in offshore drilling too, so maybe even tougher than mine, and just in tankers. We're in a unique position that shipyard capacity has greatly reduced in the past 2 decades, and currently it's inundated with orders from high-value vessels like LNG, containers, VLCCs, car carriers. And tankers having a lower profit margin at these, you know, top yards are not a priority. So it's really kept the order book low, especially on the larger sized crude tankers. You know, and there's other factors as well, which is like, what is the longevity of the crude trade? And maybe more importantly, what type of propulsion fuel should be chosen? And if we're at this like cyclical, expensive part of new building values, like do you want to add another 15-20 million for some dual fuel option or methanol? Like, I personally strongly believe that there's a longer future for fossil fuel because it's the cheapest and most efficient fuel source. And so I'm quite confident that this insecurity about ordering is actually obviously to our benefit. And this has led to a historically low order book in tankers, and more especially on VLCCs. I mean, everyone reads TradeWinds. They reported last week that like the first and only VLCC was delivered of the year. I think another really interesting thing in the bottom left chart is that we cannot see the order book for VLCCs materially grow until after 2028. You know, when we placed these orders in 2018, we ordered 8 ships at Hyundai, and they delivered 7 within a year and 1 afterwards. And we had some other Greeks order at the same time as well, who had, you know, similar amounts of ships and similar delivery windows. So they were delivering, you know, 24 ships in a year. Now it's much reduced because they have these other order books like LNG and containers. So the forward order book is still full, limiting the amount of tankers that can be built even after 28. But then it coincides with the delivery of all the ships between 2008 and 2012 that were ordered in the previous boom. And these ships are going to have to start either be recycled or exit, let's say, the trade that we trade in, like the normal trade, and then have to go into either more gray trades or cabotage trades or floating storage. Like, we see the economic life of a vessel between 17 and a half and 20 years. So the good thing about even a forward order book coming in 27, 28, that you're protected by vessels turning 20, and you have all these environmental restraints and regarding regulations and how the ships have to comply with them. So we're quite bullish that we're well protected even going forward. Moving on to slide 14, I think for all these 4 main tailwinds we mentioned, we feel that secondhand values have a lot more upside to them. And we've compared here where we are today versus the peak cycle of 2004 to 2008. But we already have excellent freight levels on a historical basis, especially since I started working for this year and last year. But I think once we make the tick up into the next level of market strength, and we see, you know, $100,000 a day plus on VLCCs on like a semi-sustained basis, we'll see buyers willing to pay much bigger premiums for prawn vessels. So I'm very confident that we'll see young vessels, you know, between the age, you know, resale up until, you know, 15 years old, increase to fill in that gap in the curve. And we're in a great position as well because our fleet is 100% spot, and we have full optionality to take advantage of the firm spot market or potential time charters and vessel sales. But for the time being, we still feel that sales and time charters are very undervalued. And I hand you back to Iraklis.
Great. Just spending a little bit of time over a significant milestone in our development. Back in December, we executed the listing of the New York Stock Exchange. Our trading liquidity is a key consideration we have identified to improve upon. Over the last year, we have managed to steadily increase our trading volume, but there continues to be substantial room for improvement. Our step with the dual listing was largely done to assist in that front, expand our investor base, and achieve better access to the bigger pockets of US investors. Looking at the trading data of the first month and a half of trading in New York, we observed some very promising signs. We already see a 50% increase in total trading volume since December 11th, while a pretty good and healthy chunk of that is traded out of New York, averaging approximately 35% of total volume. This demonstrates the potential that the US listing has in complementing our platform for opportunities in the future. Slide 16, and this is the final slide of the presentation. We are confident that if you believe in the market fundamentals over the medium term, Okeanis could be the best bet for riding the crude oil tanker wave. We have been delivering on our promises, 6 consecutive quarters of distributions, best-in-class yield, significant cash flow capacity, and track record of returning value to shareholders. We have the most modern and efficient fleet amongst peers. We believe to be the best performer for the bottom line. We have a demonstrated focus on governance and a track record of alignment of shareholders' interests. We come from a heritage of over 50 years in shipping, combining the operational excellence of a Greek private shipping company with a well-run and transparent public platform. And finally, our recent US listing, we hope, will be a catalyst in improving investor reach and trading liquidity, in our vision to become the platform of choice amongst investors in the space. And with this, we conclude the presentation, and we already see a few questions popping up.
Do we just read them and respond?
Yeah.
So, I mean, the first question, if you buy a tanker on the SDN list of OFAC, does it drop off the list? No, it's much worse. You've just interacted with an OFAC sanctioned entity, and I assume that the United States will also sanction you at some point. So no, you cannot buy tankers on the OFAC list whatsoever. Do you plan to keep your Suezmaxes on the spot market? No, I think that today, you know, I think given what's our outlook on the market, asset values, better price, the potential, not there in our opinion. We still need a lot more to go before we think the price captures the next years ahead of us. But the Suezmaxes are even more undervalued on the time charter. So, and generally the TC rates are. So no, our current interest isn't to time chartering vessels. There's always potential to do something short, like 3 to 6 months, but that reflects more like short-term trading opportunities rather than anything else.
The next one, do you plan to grow the fleet? I mean, look, Aristidis alluded to it earlier. You know, given where asset values are, it's tough to source opportunities that we consider accretive. We would love the opportunity to be able to use the platform in a way to pursue accretive opportunities, but one, we wouldn't want to jeopardize at all our capacity to distribute dividends. And given where asset values are, it's just too tough to source anything. So with that in mind, and the fact that we're quite comfortable in terms of the size of our fleet, we have no plans at all. What's your dividend policy? So we have been very vocal from day one. We want to distribute as much as possible to shareholders. There is no formula per se that we use, but we hope that our track record speaks for itself. As we talked about earlier, since we have had a fully delivered fleet, we have essentially paid out our entire free cash flow. In terms of net income, you know, taking into account our capital structure considerations, we have averaged approximately 9% of EPS.
Does the company have any plans for new buildings? I think Iraklis answered this earlier. The short answer is no. We don't think it's the right allocation of capital. Yeah. If we had to buy something, which I'm not implying we are, but I think that taking an asset that can deliver returns from today is a better use. But as Iraklis mentioned again, you know, I think we don't want to interrupt the ability for us to return dividends and the amount that we can return by using profits to buy ships at the moment. So how comfortable are you being 100% spot exposed? And the TC rates. TC rates, they're too low still. And we're very comfortable. We're also comfortable being time chartered. In 2020, we had 80% TC coming out of 2020 after the contango market. We got to do some nice time charters and lock in nice rates for what we felt would be the destocking period or part of it. And now we feel that there's tremendous upside, so we want the spot exposure as high as possible.
How many of your vessels have been diverted as of today?
3 Suezmaxes, and we've actually fixed one of our VLCCs to do one of these co-loading 2 Suezmax cargoes into Europe. The rumor about the cleaning up Suezmax to trade CPP, yeah, I heard it too. There are some Greeks who own a couple clean coated Suezmaxes. I don't know if Frontline, which was the rumored company, owns LR3s, But like if it's an uncoated ship like our Suezmaxes, you can't. Even if you clean it up, you'll still have sediments of crude inside. You'll have rust. It'll cause discoloration and affect the product that comes into the ship, unless it's purely for like blending purposes. But I think it's almost very extremely unlikely that a non-clean LR3 can be cleaned up to carry clean products.
Do you have any plans to opportunistically buy an additional second-hand tonnage? I think we've covered that. How should we think about dividend distribution? And apologies, it's quite a few questions. We're just trying to keep up. How should we think about dividend distribution through 2024 and 2025? I mean, this goes along with what I explained earlier. We want to stay true to our promise. We will continue to distribute as much as possible. We will continue to do the same assessment like we do every quarter, which means taking into account our capital structure, taking into account the visibility in terms of short and medium term, and just distribute as much out of that we feel comfortable as possible.
When rerouting an existing charter around the Cape of Good Hope, who pays for the extra days and how is this arranged commercially? It all depends about your charter party and what kind of clauses you have. So there are war clauses. War clauses, depending on who's written it and like what amendments you made, give the captain or the company the right to divert to a safe passage when there's an unsafe passage. And then some clauses state that the expense will be covered by the charter, the owner. So it all depends. We had good clauses in our charter parties, so we're protected. And I think most of the questions are.
Yeah, it's different versions of questions we have already responded to.
George Berman, give an example of triangulation. So you fix a VLCC from US Gulf to India, and then you ballast to West Africa, which is shorter than the previous voyage. You fix West Africa into Europe, you ballast to the US Gulf, you go back to India. So like the percentage of laden versus ballast is much higher. That's one simple example.
Yeah. For how long are interest rates on your debt locked or hedged? They're not hedged at the moment. So we continue our efforts to decrease the interest cost with the financing we're doing. And we've covered this.
How have developments in the Red Sea affected insurance premiums? I mean, the premiums have gone up a lot. It's gone up from being a non-existent expense to 300 to 500,000, depending on how expensive you have your ship insured. Like this expense, which is called in shipping, additional war risk premium. It's a specific insurance you get when you go through war areas. In most cases, it's covered by the charter, and so you rebill the cost to him, or you factor it into your voyage expenses. And this insurance, as well as the insurance of the cargo, is what makes the trade around the Cape of Good Hope more acceptable to the charters, because it's obviously much cheaper to go from the Suez. But once you add the cargo insurance, you add the additional war risk premium insurance on the vessel. That's where they start to get a bit closer, and it makes it feasible to trade around the Cape of Good Hope. Another thing that makes the trade around the Cape of Good Hope more difficult, and it'll create this dislocation, at least in the short term, is that refineries in Europe, they might be planning on buying, crude with delivery 25 days away from the Suez. Now all of a sudden this voyage becomes 40 days away, 45 days away, and they have this gap. So they're going to have to fill that gap. That creates dislocations in the short run, and in the long run, it stretches the fleet doing these longer voyages.
I know you love answering this one. I will leave that to you. Do you see possible expansion to other segments of the maritime industry, containers or dry bulk?
Yeah, well, I mean, this goes to slide 5.5 of our pitches and promises that I forgot what it was, but
no dilutive capital raises.
yeah, that we've said this is a crude tanker platform. Our intention is to distribute dividends and profits to shareholders, and it's a simple, clean structure, and that's what it will continue to be. If we see an opportunity in dry bulk or containers, we would do it in a completely separate entity than Okeanis, and hopefully we could list it at some point and have our current investors as co-investors there. But there'd be no relation between the two companies financially. Alternative fuels seem a long way off. What are our views? Well, I guess we're in the lowest rank of shipping, the ability for shipping to pass on the expenses to the consumer, to the receiver in our case. In car carriers, it's much easier for Toyota or the big makers to ask for cleaner fuels, but for us, we're delivering to 150 different receivers and refineries that don't have such policies. So I think that's one thing that makes it more difficult straight away. Then we traded transshipping. So before the war in Ukraine, RVs were doing a lot of West Africa to China, West Africa to India. Now, after the war started, we're doing a lot of US Gulf to Rotterdam or Brazil to Rotterdam. This, the fact that you don't have a fixed trading pattern makes it difficult to procure a bunker fuel that isn't very easy to find anyways. So I think tankers and dry bulk will take longer to react to a future fuel. And I also think that these future fuels like ammonia and methanol are going to become very expensive to use as bunker fuel. So I don't know how long and how much the world is willing to subsidize offshore use for ships, and we'll have to compete with onshore use of these fuels as well. So I think for the time being, in our view, very efficient crude tankers is our medium-term solution for alternative fuels. We have some new buildings on the private side that we're considering installing carbon capture for, but yeah, so we don't have a definite view, but I think that very efficient fossil fuels are a good medium-term solution for shipping.
Why is your other crude tanker owners price over NAV better than other product tanker owners? I mean, I've noticed a couple of research analysts listening on this call. Maybe it's a better question for them, but there's obviously a link between and a balancing between the quality of the fleets and the levels of asset values, along with the expectation in terms of future earnings, dividend capacity, etc. I don't think I can give you a better answer to that. I don't know if you have a better idea.
No, I mean, look, I think the current strength in the clean market, it's brought up their pricing very nicely. So they're trading closer to where some of the top crude tankers are trading as well. And I think everything else has been basically asked and answered. Yeah, we agree. Cygnus is a beautiful island, and so are all the other islands that our ships are named after.
A few that have been sold as well.
Yeah.
Listen, we have been trying to combine a few of the questions we've seen. If there's anything that we've missed, please feel free to reach out directly to the IR email, which is posted on our press releases and website, or through Nicholas and team through Capital Link. Would be happy to connect. I don't see anything else coming through. Yeah, Nicola, I think we should cover most of it.
Well, that was a very interesting and detailed presentation. Great attendance. and you got an avalanche of questions. So thank you very, very much. First of all, to all of the participants, and of course to Aristidis and Iraklis for your presentation. Again, thank you to everybody for taking the time to be with us. As a reminder, this webinar will soon be available for replay, for access upon demand, and it will be available on Capital Link's website at capitallinkwebinars.com and also on our YouTube channel, on Capital Link's YouTube channel. So thank you to everybody, and I wish everybody a wonderful weekend.
Thank you, everyone.
Thank you very much.